Hi everyone, you're all very welcome to our Week in Markets weekly recap of the volatility and market volatility and movements, as I said, over the course of last week. So today we are going to be reviewing the data, the very, very prominent central bank meetings, of course, how the markets reacted last week, and of course, where we closed into the weekend, with obviously a quick view of to where we are going to be looking at this week in terms of the volatility. So I suppose looking at the market broadly last week, we had 2 or 3 very, very volatile days, Tuesday, Wednesday and Thursday, with a lot of the volatility coming Wednesday night into session close, as I said, into Thursday, broadly speaking. Now, of course, on Wednesday, we had the FOMC, Fed, led by Chair Powell, increasing interest rates again by 25 basis points, and that is still continuing to higher. Of course, on Thursday, we had a shock 50 basis point increase by the Swiss National Bank, and that's very, very interesting given the recent volatility in Credit Suisse and, of course, the UBS Credit Suisse acquisition as well, obviously factoring that into market conditions. Thursday afternoon, we then followed it up with a further interest rate hike by the BOE, 25 basis points, 7-2 vote in terms of the increase, and we saw UK interest rates rise again in 2023. So I suppose firstly and foremost, let's have a quick look at the economic data. So broadly, as I said on Wednesday, we had the dot plot by the Fed, we had increase in interest rates, we had a fairly overall fairly hawkish approach. Now, of course, we had a tit for tat in the indices up and down Wednesday and Thursday, and we'll obviously be looking at the movements now shortly. And of course, we had quite a bit of volatility in terms of the press conference as well, where we saw obviously that fairly significant liquidity sweeps back and forth between kind of 6:30 or 6 and 7 o'clock, and then by 7:30 we actually saw the markets really sell off and push lower into the close, which was a fairly clean move from a price action perspective. As I said on Thursday, we did obviously have the 25 basis points increase by the BOE, 7-2 vote, increasing interest rates to 4.25%. So at this current rate of stance, Fed at 5%, ECB continually to aggressively increase rates, and BOE raising rates as well, showing that central banks are still looking to do more in terms of tackling this inflation narrative. But I suppose at one point we have to look at, right, interest rates are going up, but you only have to look at the 300 billion in QE that the Fed has repumped into the markets in the last week or so, given the contagion, given the issues, the liquidity issues with Silicon Valley Bank, with the Signature Bank, and the broader banking contagion, even with FRC last week, also down very, very heavily on the week as well. So yeah, just be kind of wary of that. The increasing of interest rates is fine in one regard, but if they're increasing interest rates in one aspect, but then pumping 200, 300, 400 billion into the markets to prop up the markets in terms of liquidity through the plunge protection team, very, very useful thing to Google for those of you who are interested. It's a little bit counterproductive, a little bit counterintuitive, okay? Now, the reason why so many of these banks are having these issues is because they place so heavily betting against the Fed in terms of not increasing the rates as aggressively as they have, and they've been caught out on the wrong side massively. And that's exactly what's happened with the Signature Bank, and that's exactly what's happened with the Silicon Valley Bank, where bailouts and stuff like that have to take place in order to kind of prop up the broader markets to prevent that wider spread contagion from factoring in to a lot of these other regional or medium-sized banks. Okay, so that's kind of really the big talking points last week. As I said, we had interest rates in those 3 banks. We did obviously have a broad raft of data. We had Canadian CPIs. We've had RBA meeting minutes. We've had PBOC interest rate decision meeting, which was no increase. So that was a bit of a non-event. And then, of course, into Friday, we had a kind of a mix of raft of European and US data, broadly speaking. But overall, indices pretty much back and forth. I would say broadly, they're nearly flat on the week. And we'll obviously look at the price action now in a second. When we look at the broader data ahead for the week ahead, we've got no real interest rates as well coming up now for a number of weeks. We do have business climate, we do have bond auctions, we do have a lot of kind of smaller run economic data points like the Schiller Price Index. Those things are very, very important from a kind of a minor perspective in terms of all of these different minor pieces, your retail sales, your house price indexes, your consumer confidence. All of that gives I suppose the market participants, market analysts, a broader insight as to how the general economy is feeling, the general population is feeling. And of course, the more pressure and strain that the general population have, generally the negative the effect that that's going to have in the markets, broadly speaking. So just be kind of wary of that this week. Now, when we look at, I suppose the real talking point is, let's look at the DXY, because the DXY is really kind of the backbone. If you're trading major pairs, FX pairs like Euro USD, like GBP USD, you really probably should be looking at the DXY, because the DXY is the centralized fulcrum for identifying the relative performance or sentiment in the dollar, right? Because of course, if the DXY is moving higher, you should be looking for a stronger dollar. Therefore, you should be selling Euro USD, you should be selling GBP USD, you should be buying dollar yen, if that's the narrative that's posed in the markets. Now, when we look at the broader markets for the last few months, we've been talking about this 105, 105.50, and I'm sure for those of you watching these videos regularly over the last 4 or 5 weeks or so, again, don't forget to like and subscribe. You will see that we've had that kind of massive roar of dollar strength. Now, of course, that's very, very quickly eroded in the last few weeks. Of course, the liquidity issues, there's always going to be a certain narrative posed to allow the markets to move in a certain direction, right? If you can read price action clearly, you can identify cycle analysis, you can identify the crossover between where buying and selling begins and vice versa, you'll very, very quickly find that in broader markets, there will be a certain narrative posed by media, by institutions as to where the markets are going to go. 90% of the time it happens, right? So I think the goal there is then to be able to recognize, well, where is cycles beginning? Where is cycles ending? Where are very, very prominent price action levels? And then you can start to reevaluate then to say, well, there's going to be a very, very clear potential scenario where the price action could make a move off of a particular area of interest. And of course, that's exactly what happened here in the DXY, because of course, we've seen a very, very clear selling bias from this 105, 105.50 level. And all we've effectively done on the daily is work itself back into this 102 handle. And that was something that we talked about last week before, is could we see this contagion run off and see the DXY run back into this 102 handle? If that was the case, and you're seeing DXY run back into 102, we should be looking for euro dollar strength. We should be looking for GBP USD strength. We should be looking for dollar yen weakness. And effectively, that's exactly what's played out. We've seen very, very clear selling from this 105 handle all the way back to 102. Now, of course, we have seen a little bit of a bottom coming through on Friday. Of course, that's fine. But again, very, very strong market reaction off that daily crossover, that daily liquidity area at 102. And that's exactly what's happened. Now, in the 4-hour structure, if you look at DXY, clear break of structure to the downside, getting the pullbacks, further kind of decline this week, further decline, and then we've ran off all the way back into that daily zone. Now, it's from this daily zone, this 102 handle, that we've actually seen a very, very strong push higher in the DXY, which of course has led to Euro USD making a selling correction from this 108.50, 109. GBP USD making a selling correction from this 123.50 level that we've kind of talked about. So it's just about being wary of that. And I think if you can add that into your analysis, regardless of short-term, higher time frame, regardless of the strategy that you're utilizing, it'll probably give you a little bit more structure, right? Making sure you're not getting caught out on the wrong side, because of course, then you can then identify your prominent areas. You can identify where the price action is most likely going to get a bounce. Maybe not all of the time, but in most circumstances, you can start to, I suppose, pinpoint that. And I think from an analysis perspective, you don't want to obtain what we call analysis paralysis, where you're just looking at the price action, but you're not getting any clarity from it. I think progress and clarity are two of the most important things that needs to be obtained when you're looking at price action. Making sure you can identify price action cycle analysis, making sure you can identify the crossover points, making sure you can identify logically, well, if we're going to sell off or we're going to rally, most likely it's going to come into this area where we've seen a market reaction from previously. I think that's important as well. Now, at 103, it's really kind of interesting now to see where do we go from here, right? Because normally speaking, when we get a very, very clear selling bias, we then look for a pullback where we break structure. So we'll talk about this now. The break of structure is where we have sell-offs, we get an aggressive breakout to the upside, taking the order flow out, then we get a final move back into liquidity area, and then we look for buying around of that kind of important influential area. Now, this is just the Nasdaq as an example. But when we look at Euro USD, when we look at GBP USD, we've seen, as I said, fairly prominent buying in the dollar on Thursday into Friday. And of course, that's allowed this DXY to really correct from that 108.50, 109 level. Now, I think at this point, would we really be surprised to see another run up back into this 108.50 level? No. I think it would be nice now to see, could the price action break back down, come back and maybe test this area down here around 102.35, and then look to see, is there a hold up, and then can we start to pinpoint maybe that next phase of medium-term dollar strength? Because of course, what goes up must come down eventually, and we can see it time and time again. That is just cycle analysis. Okay. So I think the first couple of days, I think really Monday into Tuesday is going to be important this week to see whether we get that weaker dollar play again, run up in terms of dollar weakness back into this level down here. Whether that happens or not, let's wait and see. I do think if we do open up, let's say risk averse, and we see dollar strength, once you see kind of price action breakthrough 103.25, 103.50, you're probably going to get that continuation to the upside, and then it just becomes a case of waiting to validate certain scenarios. I think you need to be nimble enough to look at both sides of the bias, buying and selling, and then identify, well, where are your invalidations? If you can identify where those invalidations are, uniquely, you're giving yourself clarity. And as I said, clarity is so important, because then you're trading on the right directional bias rather than, as I said, being married to a certain viewpoint and then moving your stop loss, all of these other negative traits that leads to obviously increased drawdown, etc. So you have to know when to cut your losses, but you also need to have clarity in terms of the purpose, in terms of what you're doing. So at this point in time, personally, this week, I'll be seeing if there is a reaction up here around 108.50. More broadly, I think this area about 108.70 does become quite interesting. Given the daily fill here, given the 4-hour fill up here at 109, I think it'll be important to see if there's a second run up back into this level, or if it's a case where euro dollar just weakens off. And then, of course, what happens then? We're heading back into this 106 handle down here. So I suppose those are the two scenarios. Wait and see if there's a reaction from up here, or secondly, waiting to see if there's a reaction down here in Euro USD. GBP USD, symbolically very, very the same. Broader range, broke through lows, immediate reversal, taking of highs, taking of lows and liquidity. Then clear bullish run up, as I said, back into this region. So if you're looking on the daily, very, very prominent reaction from this 123, 123.50 level. If you're looking on 4-hour only, you'll see that it hasn't been filled. So there is maybe the potential for one last push. However, when you look at price action, we're still kind of trending to the upside. So if you're looking at the order flow now, 1-hour structure, highs, lows, new highs, short-term lows, new highs again, short-term lows. Where have we come back into this area here at 122? So at this moment in time, it does look like cable's going to have another run up back into this area up here. I would just be cautious, because of course you are high up in the range. So just making sure there is clarity, but wouldn't be surprised to see kind of cable run back up into this region. And of course, if cable runs up back up into this region again, then you're most likely looking at this scenario where we see that weaker dollar. So obviously, let's wait and see what happens from a market reaction this week. Dollar yen is quite interesting, because of course that's been just playing out particularly nicely relevant to that of the DXY. So the DXY is rolled off from the daily, of course, back into this liquidity area down here. Dollar yen has done the exact same. 102 on the DXY hasn't fully allowed us to get to 129 on the dollar yen. We have seen a fairly strong reaction from this region down here around 130, obviously during Friday's session. But you look at it still, the order flow is still very much bearish, right? You'll see it again. This was the February NFP pump, very, very aggressive cycle move. Very, very clear break of structure, break of trend, all of this bullish order flow taking out, price action returns back into this value area. Now, at this point in time, we are still migrating lower. There is potential for more downside. I will be watching for 129 personally myself this week, because, of course, if we are to get 129, again, that would mirror up very, very nicely for one more kind of 4-hour dump back into this kind of 102.20, 102.30 level, which might allow for that final run down into this 129 level on dollar yen. Now, Aussie again has been quite interesting, because of course in the daily, Aussie USD, obviously very, very strong reaction. 67 broke through, price action comes back up, takes out 4-hour daily liquidity between 67.25, 67.50. If you go back to last week, you'll talk about us mentioning that specific area, and we've seen a very, very clear reaction. Now, if you're looking at this order flow from where we are on the 4-hour, we've got bottom, higher highs, higher lows, back into value area, new highs again, back down, new highs again, mitigates this region over here to where we've got this sharp selling reaction. Now, at this point in time, given we've created kind of bullish order flow the whole way up, we've broken through this kind of structured area here around 66.50, 66.60, should I say. It wouldn't be surprising to see kind of one last move again back up into this region to allow potential selling back down, at least short term, into 65.80. But would it allow a deeper runoff? Well, let's wait and see, because of course anything can happen. Let's wait and see. Of course, if you look at Aussie, what goes up must come down eventually. So if we are to sell off through, let's say 65, 65, 65.80, 65.70, you really could see that next phase of cycle analysis. You've got an area here around 65s. You've got another area down here around 63.50. So those do pose as very interesting downside targets should that selling bias continue, and just being wary of that, broadly speaking. All right. So that finishes the FX. If we look at gold very, very quickly, gold has been on just a complete and utter rampage, really, when you look at it, because of course, weekly, this was obviously the Russian invasion of Ukraine, where the geopolitical tensions arose from. Cycle analysis, this was obviously dollar strength through 2022. This was dollar weakness through October, November, December, and the early parts of 2023. And of course, the geopolitical issues, the acquisition of vast sums of gold by Russia, China, and the BRICS nations broadly has seen gold rally back up to this very, very prominent area of 2000. Now, again, we were kind of looking at this 1946 level on the weekly, completely rejected, sold off. We've now broken through again. So order flow is now kind of taking out this liquidity area. But if you look left broadly, you will also see this other secondary level up here at, shall we say, 2000, roughly, approximately speaking, 1997. And we're starting to see a little bit of a top here form again. So would this be higher high, higher low, new higher high, pull back again, maybe into the 1850s, 1860s? Let's wait and see, to maybe allow for that third run up where we ultimately try and take through the high. So this wouldn't be an inconceivable scenario, but at this moment in time, let's just wait and see. Okay, let's just wait and see, because of course we are forming very, very clear short-term daily tops here, as I said, just underneath this, or just around this 2000 level. When you look at 4-hour structure, very, very aggressive bottom, breaks of structure, so bearish order flow, breaking through trend, back into liquidity area, massive run up, just clear filtration of gold strength into this, as I said, 1997 level, where we've actually obviously formed short-term highs. And if you look at the 1-hour, 4-hour structure, still holding very, very nicely and underneath. So we are kind of trying to form kind of like an M-shaped top. If you look at 4-hour structure, you will also see price action navigating a closure above, then coming back underneath, taking out the structure here at 1985, where we're closing at 1978. So at this point in time, would it be completely inconceivable to see us now say, well, we've started to form consolidation at key level, we've identified ranges, we've identified the false move in the 4-hour, we've identified the break of structure on 1-hour and 4-hour back into these short-term areas. Could we see price action, given that we've taken out the range lows? Could we see us break down? Could we see us return up? And could we start to allow a deviation in selling bias over the next couple of weeks? Well, let's wait and see. But I know for a fact this area here around 1990, 1994 should become very interesting for selling should any short-term correction play out, because you've got a very, very nice run-up from the mid-1990s all the way back into short-term downside targets of 1940s, 1950s, which alone is a nice $40 to $50 move. And of course, you look at where the gold prices has come from, way down here at 1820s, 1840s. It could be the start of a potential runoff. But now, obviously, let's wait and see, because if these geopolitical tensions continue and rise and becomes more heightened and pronounced, we're then merely looking for price action to take out these highs here above really 2004, 2010 region, and then really seeing, can the price action then break to new highs, come back into the short-term liquidity area, and then start pumping. So those become the two ultimate scenarios on gold at this moment in time. All right. So then moving across to indices has been very interesting. S&P's is one that I've been trading quite heavily this week myself. Order flow has been so clean when you look at it broadly speaking. When you look at 4-hour structure, obviously price action selling off, bearish trend, forming bottoms at this 38.20 level. Now, of course, if we go back up to the 38.20 level, that of course is the January NFP. So where this cycle of S&P strength has come through in the last, let's say, week and a half or so, last 10 days or so, has come from January NFP. So we've rallied up through January into the early parts of February. We've sold off all the way back down mid-February into early March. Cycle analysis, what goes up must come back down. And of course, we're now starting to ascend higher with highs and lows continue to play out. So the order flow in this is so clean. So really very easy plays here. When you look at 4-hour structure, so this is obviously this 39.20 level is also 4-hour structure. 1 hour has been quite interesting because of course, if I look at 4 hours, you can see it there. Highs back into lows mitigates this. Selling ends, buying impulses up. Doesn't quite fill this area up here at 4050, so that becomes a very another prominent level to come back into. Selling comes back down initially, so we've had FOMC selling on Wednesday with a little bit of a dead cat bounce recovery early Thursday, but of course Thursday allowed that deeper runoff again all the way back into Friday morning where we hit this 39.20. So all we're really seeing is liquidity being taken out on both sides. So liquidity area here, as I said, 39.7, 39.90 into 4,000 being hit on Thursday. Sell-offs all the way down to the 4-hour region at 39.20 where we got profit taken and the markets rally on Friday. So at this point in time, really looking to see, can the indices continue? So again, that's enabled that dollar narrative. If we see dollar weakness continue to play out, 102.50, then really we should be looking for indices strength again, price action coming up, really looking to break back above this 4,000 level and trying to kick on to 4050. And that then completes this cycle where we've had higher high, higher low, higher high, higher low, new higher high, mitigating of this prominent short-term highs which were formed from beginning of March. These are March highs. And then of course then you can see, well, if that plays out, can we then try and break through 4050 and push on to the upside? So that is a potential scenario. So at this point in time, just wait and see what happens with the DXY, because of course that's allowing us to gather influence and bias to say, well, is it risk on, is it risk off, and then having clarity broadly within the markets from there. Nasdaq is very interesting as well, because of course we've had that reaction from 12.8 early parts of February, sold off, very clear trends. We've a break of structure back into liquidity area, phases of selling price action, very clear, break of structure, taking out this bearish order flow, comes back down into an accumulation zone where we have this 1 hour chop and volatility, consolidation, breaks through structures, inducing liquidity on the downside, the selling bias almost immediately reverses back into range. So you know that's a stop hunt, you know that's a fake out structure where we're inducing sellers only to take the markets higher. And of course market makers have proved to be very clean, because we've taken out the highs of the short-term range, we've come back down into this 1 hour internal value area at 12,000. We've then continued to churn higher from short-term accumulation to where we've had a very iggy and eeky back and forth between 12,600 and 12,900 due to the FOMC this week. So this was FOMC selling on Wednesday. This was back into new highs, structurally speaking. So very choppy in the Nasdaq. But of course, if you delve out to the 4 hour structure, it does look like the Nasdaq now is going to try and have a run higher through this 12.9, through this 13,000 level. Because of course, if you look at the order flow, you will see short-term highs, new lows. If you exclude the wicks, short-term highs, new highs, pullbacks, and we're looking to try and go higher again. So it does look now that potential for indices strength again this week could become the order of the day. But I definitely prefer the price action in the S&Ps over Nasdaq, because you're getting less wicks. So that's again due to the fact that there's more traded volume on the S&Ps than the Nasdaq. But should we get a daily break really above this 12.8, and of course if you look at your broader price action levels, you have a very nice area here from dating back from last August, last September, where this 12.8, 12.9 level has become very important. So if we're getting above 13,000, we really should be looking for that continuation in Nasdaq strength to continue, and you could very easily see another run up into this 13.5, 13.16, 13,600 level this week. So again, just being open-minded, look at your scenarios, look at your sentiment, risk on, risk off, I think is important, because that can feed back into bias, and then having clarity broadly from that. All right. Now, lastly but not least is Dow Jones. So Dow Jones is very interesting, because of course, if I'm looking at Dow Jones, I'm seeing, while aggressive bearish trend, marginally breaks through highs here from August, comes back down. There's a lot of unfilled areas down here. So this is why I was a little bit more concerned with Dow Jones, because of course, like, we are finding bottoms here at 31.5, 31.6, but unfortunately it's not mitigating any of this run up zone from October, right? Because of course you've got 30,500, you've got 30,000, you have a lot of unfilled liquidity down here. So At this point in time, Dow Jones is a bit of an enigma because, of course, there is downside potential. But broadly, when you look at the markets, you'll see that Dow Jones now is becoming corrective, right? We've had consolidation. We've had break of structure. We've short-term order flow, particularly on 4-hour. You'll see it as well. Range, breakout, back up to retest key price action level. Breakdown, massive break of structure through consolidation into bottoms where we're forming this zigzag structure. We come back up, we mitigate this 32,700 level, 32,800 level, where we've obviously sold off initially on Wednesday. If we look at 1-hour structure, we've broken down, we've come back up to mitigate and fill this 32,500 level, and then we've sold off from there. And then this most recent sell-off on Thursday has just come down to mitigate this area here. You can kind of see it mitigated at 31,775 to the area. And then we've seen this massive reaction back up. So at this point in time, it does look like Dow Jones is going to come back up into this region. But I would just be a little bit hesitant with the downside areas to see, right, medium term, could we actually sell off broadly through that? Well, I suppose that's only time will tell. But at this moment in time, we have seen very back and forth through the region. And of course, if you're even looking at this now, you can see consolidation, breaking of lows, back into highs, retesting of lows, takes out the short-term highs of this region here, all the way to come back down into this zone. So if you're looking at that broadly, you can expand that out. Very, very clear market reaction, back down, taking liquidity in the upside, taking liquidity in the downside, and we're now pumping higher. So at this point in time, again, if Nasdaq, for example, S&Ps were to break through those two prominent levels, 4,000, 13,000, 12,900, and Dow Jones, you're really looking at coming into these levels, potentially breaking through. Now, of course, if you're looking at Dow Jones broadly, you can see this as potential bottom, impulse, back in, impulse up again. Could we start working ourselves back up into some of these higher levels? 33,400, 500, or you've got 34,000 up here. We're seeing very, very volatile movements in the Dow Jones over very, very short periods of time. So just be wary of that, right? So I think, as I said, across the board, short-term dynamics this week will play a massive part because we could very easily take out some of these levels. But as I said, root cause is let's go back to the DXY. Let's see how does the dollar relative performance open up this week, and then we can start to eradicate or remove certain scenarios based on that as well. All right, so last but not least then is the European indices, and DAX has just been so clean, or FTSE has been so clean. So we've had FTSE run up again, previous longer term range. Let me just go full screen for a second, folks. Massive range up and down, takes liquidity on the downside, takes liquidity in the upside, comes back all the way into this kind of medium term area around 7250, 7300. A lot of the upside liquidity has been taken out, more particularly this impulse. So if you isolate this impulse here from the end of December into the early parts and mid parts of February, we've had a very, very aggressive move up, consolidation for a number of weeks, very, very aggressive move back down. And that's really what's important here. Identify your crossover points, having patience, for God's sake, right? Don't get sucked into the shorter term volatility. You know that cycle analysis is what goes up must come down. Same with the upside. What goes down must go back up eventually. We've seen very, very aggressive selling into this value area. We've seen a very, very clear break of structure into 7,600, which I'm going to show you now in the 4-hour. Taking out short-term highs here. Not fully taking out this one, but that's okay. Run up all the way back down into this liquidity area here. So really now this week, we should be seeing if there's any sort of reaction from this 73.20, 73.60 area to then see, well, can we push up again? Can we migrate another move higher in the FTSE to undo a lot of this selling, aggressive selling that we saw through the early parts of March, right? March was a bloodbath for the FTSE. Let's see, can we undo some of these losses, or is this just merely another run lower for the price action? So as I said this week, keep an eye on this region. There is structure developing there so far in the FTSE, but obviously going to be an interesting couple of days on that one. Now, again, the DAX is almost identical to the Dow Jones. We've had range, highs, lows, back down to this 14,500 medium-term area here. Aggressive run up to the upside, breaking through the structure. So we've got structured break, actually takes out this structured high as well, all the way back down to the 4-hour area where buying has come back in. So at this point in time, I would not be surprised to see the DAX actually try and break through this internal structure here at 15,100, 15,200, and actually try and progress to the upside, similar to the potential on DAX, on the Dow Jones, because of course we've had consolidation taking the highs back into the area. Could we now progress up similar to that kind of wider sell-off that we saw there? So wouldn't be completely inconceivable, wouldn't rule it out, so just be kind of wary of that one. Euro Stoxx as well, almost identical. However, the area didn't fully get mitigated. Now, we did come very, very close to the region, so you could probably, in most people's eyes, that's probably a mitigation because, of course, comes down, very, very aggressive move higher. We're starting to rally again. But at this point in time, similar scenario, previous consolidation, taking of highs, aggressive move to the downside. We've taken liquidity and the order flow back into prominent area. And then, of course, we're looking to rally again. So would it be completely inconceivable to see market rally back up into this 42.50 level? Well, we're 100 points away as things currently stand. So worth keeping an eye on that one. As I said, dollar strength is going to be interesting this week. Keep an eye on that. Dollar strength, dollar weakness, because that's going to tie back into all of these or most of these assets that we're looking at in terms of the market review. So that's pretty much it for the week, everyone. As I said, if you love the comment, feel free to drop us a comment, like, subscribe. We will be doing some very, very interesting things in the next couple of weeks and months. So, of course, stay tuned. We do have some from the company perspective. We do have some very, very interesting and important announcements coming up also, which, again, is hoping to going to continue to differentiate ourselves from everyone else and all of these other prop firms or so-called prop firms. And then, of course, as I said, this week, volatility. So trade safe. We've had a lot of volatility last week. Have clarity in your focus and your analysis. And as I said, trade safe and have good risk management. Take care, everyone. Have a great week.